I'm going to the city and I'm gonna do a city show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone reclining, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week. It's a look back at what happened in the financial markets in the last week, and a look forward at what might happen in coming weeks, and hopefully lots of great ideas and opportunities for you throughout the show. The stock market kept its rebound going last week, and then succumbed around midweek to some profit taking after a huge 11% leap in 11 sessions for the S&P 500. Buyers came out of the gate on Monday, and that happened as Tesla came out and said that they're going to split their stock and issue a stock dividend. So buying came in the tech stocks and in the NASDAQ, and that helped lift the market. Tuesday, there was a report that Russia said that talks were constructive between Russia and Ukraine. And Putin said that they were going to be cutting military operations around Kiev. At the same time, on that news, gold, silver, oil, dollar all got hit very hard as the need for safety seemed to go away. Stocks rallied again that day, but Putin, of course, is lying. And in his warped mind that burns down whole cities and kills children, he's not stopping until he thinks he has a win. He's just moving troops around and resetting, regrouping. The question may be, are sanctions really working? Well, if you look at the Russian ruble, you will think not, because it has now a full recovery. And that must mean that they're able to do business or forcing business to be done in rubles, and probably the sanctions at this level are not working. And it might mean that the West has to hit Russia even harder. On Wednesday, stocks started to soften. Ukraine said, well, the talks, they're not going so well. And sellers came back into the market as it got softer. Thursday, that was end of the quarter, and people are often looking for a markup. However, there was already a huge move up in the markets, so there was no markup. In fact, the S&P 500 fell 72 points on the day in some profit taking, down about 550 on that day on Thursday. It didn't help that Russia was still bombing, and at the same time, President Biden said that he was going to create relief by issuing 1,000 barrels a day out of the SPR, Strategic Petroleum Reserve, over the next 6 months. That's 180,000 barrels. And that, by the way, is supposed to be for an emergency. You have to wonder, with the war in Ukraine, is this an emergency? What is the emergency? Again, government will not let anything in the free markets work. They just keep working to fix the problems that they created. And if you are a proponent of alternative energy, and certainly we need to move in that direction, you have to let oil rise to a level that the economics actually work. You have to have the technology catch up, and you have to have the pricing such that it makes sense for people to develop more and more alternative energies. You can't do it by manipulating prices, and the government, no matter what, will try to micromanage and manipulate, and all it does is hurt us. And the government, well, they just keep creating these problems, and I think the government actually is the national emergency. The Fed, their news came out from the Fed, by the way, today, that their PCE index, that's the deflator that they often look at, up 6.4%. That's the highest level in 40 years. That's the one that they wanted around 2%. But then, of course, they created this problem. For the quarter, actually, stocks down 4.9% after being down more like about 14%. And that still is the worst quarter since the pandemic in early 2020. But the bonds, that was a nightmare. Bond market, the worst quarter since 1980, 42 years, as bonds absolutely collapsed and we saw interest rates spike. Boy, we have mortgage rates up near 5%, and that did change very quickly. Friday morning, the buyers did come back early, but then they paused and all of a sudden started to move down again. The unemployment rate came out at 3.6%. That's back to within 0.1% of a 50-year low for unemployment. And wage inflation, very strong, the highest level in over 40 years at 5.6% year over year. And the Fed has a lot to do. And with this kind of strength showing in both inflation and in the employment situation, they're going to be aggressive. And you're going to see some half-point upticks in interest rates, despite the fact that you have a war going on in Russia, Ukraine. The Eurozone also has their issues, and they reported that their inflation rate up 7.5%. They were struggling to get it up also to about 2%. And Lagarde, who came over from the IMF and now heads up the Eurozone central bank, well, I think she's just plain incompetent. But I think that a lot about a lot of the central bankers in the world. So the stock market has followed our analysis very closely. We thought that, it would peak early in the year, have a decline of some consequence down into the March timeframe, which is exactly what happened. And then there would be a relief rally that we talked about, that the market would probably rally into the May-June period and then peak. We're going to actually show you those charts later on in the show, and you're going to find what I bring you then when we do the stock market review pretty fascinating. While this rally is quite strong, again, it is very few stocks that are driving it up. Apple had a 13-day monstrous rally as analysts came out really loving the stock and the fact that there are some new monetization schemes that they think Apple is working on that are really going to pump earnings. So Apple got a very big uptick. It did pull back the last couple of days, but don't be surprised if it does start to move up again. At the same time, I'll show you at the end of the show how NASDAQ and Russell are lagging. Russell lagging horribly. There is something else that's lagging pretty significantly that I think is important to show you. 2 months ago or so, I showed you HYG. This is the high yields. These high yields are representative, of course, of corporate situations. And I had showed you that there were some tops that had formed and something was going on very similarly that often negatively affected the stock market. Let's take a look right now at the current situation for HYG, and I think you're going to find this incredibly interesting. So what I had shown you is that this big saucer top brought this big decline and the bear market over here. This market that was kind of a mini bear out over here, and there was another mini bear right over here as you see this saucer top. And once it made the top, it fell for about 3 years. Once it made the top here, it fell for 2.5, 3 years over there also. And now this is what I showed you. Let's just zoom in here so that you could see this actually quite clearly what's going on. So I've overlaid the stock market. You can see in here as the high yield bonds break and start to move down, the stock market goes with them. They generally trade very much together. And here, post-pandemic, you had this huge rebound. You see, it came way, way down over here and then rebounded way, way up over here. And that was the post-pandemic rebound, was very strong. And you see the stock market, which is that line right over there that I'm highlighting, had that big rebound also. Now the stock market had this 11% rebound there, but high yields, as you can see right there, they're going nowhere. They could barely rally up to what is that 38.2% retracement. And what this points to is a low in July, August. Remember that the stock market and the high yields often follow each other. And that's actually what we expect. And this is one of the reasons that I believe that the stock market is in a bear market, and that the rebound we're having right now, even if it comes up and tests up near the old high, is still going to end up resolving itself as a bear market. There's a lot more to go. This points to a July-August low, but then there's another low way out over here. You can't see the date. I'm trying to highlight it. That takes you out into early 2023. So the question is, will the bear market end in the late summer and fall of this year, or will the bear market go all the way out into next year? That's right, I'm saying bear market because I believe that this is a really strong warning, as it has been, that this rebound that we're having in the stock market is simply just that, a rebound, and that there are more problems ahead. With this period in here where the stock market is picking up over the past several weeks, I said to you, when this period does come, it's going to be a gift. The S&P 500 may stop at what is 3/4 of the way back or 90% of the way back. We don't really know for sure. All we do know is the other indexes are lagging and wouldn't confirm. And there is very big risk that comes the summer, if not sooner, the stock market's going to have big problems again. We're going to give it about 4 to 8 weeks more of this rally, with maybe closer to 8 weeks making sense, and then another period of severe downside action coming in the markets. Make sure that you act wisely, because I think this is a gift. For the week, the stock market indexes, well, narrowly mixed, as the big upside we saw early in the week reversed. Most of the indexes are up or down small fractions, though the Dow Jones Transportation Average is down about 3%. That took about the worst of it this week. 30-year bonds up about a point. They were up 3 points. The TNX, the 10 years, loses about 6 basis points of yield. And the yield curve is around flat. A lot of discussion about the inverted yield curve, and it keeps ticking back and forth. The biggest inversion is between the 20s and 30s, which is kind of a blip there and a little unusual. But we're going to see this yield curve invert in a steeper way going forward, but maybe not by a huge amount. And sometime soon I'm going to do a big picture analysis on the bond market, and I'm going to tell you why I think that the worst really in yield is probably over for the bond market, or the worst in price is probably over. The gold market loses about $33, silver down about $1, a much bigger percentage, and that to us remains a second half story where we think that the metals will do much better. Dollar fell early in the week, but then rebounded back for a small loss, and we think it is chopping around to make a top end there. And oil down about $13. It fell sub 100, and that was, of course, on the news of the SPR release of 1,000 barrels a day. Again, I think that is absurd, because it's price manipulation versus saving it for a national emergency. Coming up, you got everybody. The whole analytical team today is going to be on this show. Ivy's going to illustrate short-term swing trade planning, and he's going to do that on DIX, DKS. Really interesting analysis he's going to show you. Katie is going to illustrate our cycle low timing tracker, and she's going to show you analysis on Walmart and why our tracker picked that up as a bottom, and then it rallied strongly. I'm going to give you a little peek at our special cycle analysis workshop, special that we only bring about every 6-7 months. So if you've been waiting to learn our style of analysis to take our workshop, this is a huge discount, so now is the time to do that. And then Matt is going to demonstrate briefly our live stock index report chart stream. This is for active traders on the indexes, and you're going to love what he has to show you as he really explains that to you. And then I'm going to give you a stock market analysis, and also honing in on the VIX. And the VIX is kind of telling us about the timing for the peak in this rally that we think we're going to get in the stock market. And that'll help me fine-tune it a bit, and I think you're going to enjoy that. I want you to go to the askSlim.com website, really explore what you see in there. If you're new, you can become a free member and be notified when we put up some of these things in our shows. If you're on YouTube, please do subscribe to our channel. Click the notification bell, and then you will know when we put up videos. We put up a lot of them. Do like this video. Give it a thumbs up, as it does help us. And on Twitter, follow us at askSlim. For any questions on our membership, huge offerings of education and analysis, and especially for this special link on our cycle analysis workshop with this huge discount I'm going to show you, right to Matt at askSlim.com. This is a preview of our stock sectors video, a member video. RV is going to illustrate to you short-term swing trade planning. The whole video, if you're a member level 2, 3, or 4, has got 7 long ideas and 5 short ideas. He's going to show you right now how this all sets up as he does analysis for you on DKS, that's DIX.
So this is DKS, and what we see here is the likelihood of a major top that has formed. You can see multiple failures at the highs, and then we had this really sharp sell-off that almost broke that prior key weekly cycle low at 89.21. After that, we got a very modest 4-week rally and are already seeing signs of failure versus that intermediate resistance zone from 113.5 to 119.5. If we were to break below this key weekly cycle low at 92.31, it would be a good night, and we would look for a pullback going out into the fall. What are our key levels on the downside? We have a 61.8 at 81.50, a 78.6 at 72.5 or so. If we go ahead and switch over to the daily chart, you'll see what we're looking at here. And just as a heads up, we do have a short side idea out for askSlim level 3 and 4 members in this name. We have this dominant cycle, which is really pushing down right now. And we also have this minor cycle pushing down. Now, what I want to highlight is this minor cycle low that formed here right around that end of March time period. You can see we got into the rising phase of that minor cycle, and then we've since had a breakdown here. So now we have this minor cycle pushing down as well as that dominant. So we are looking for risk here on the downside. Our favorable entry for this idea is in this zone from 106.30 to 109.70. If this were to close back over 114.35, that would render this idea no longer valid, and we are looking for a move to this 78.6, which comes in around 97.20, and the prior cycle low, as I mentioned, at 92.31. Our next key short-term low is due 422 to 428. So that's the overall picture here in DKS, a bearish look both on the weekly as well as daily time frame.
All right, great work by RV, and we always love the high quality analysis that he brings. This is a look at our cycle low timing tracker. This is now in beta, and what this does is highlight bottoming conditions and long side opportunities. Katie Anagostos is going to bring you this review of Walmart, where she applied. Excuse me, I sneezed right on it. Where she applies using this bottoming tracker to show you how it then evolved into telling our members that Walmart was in a bottoming area and likely to go to the upside. So I think you're going to see this. Katie Anagostos, our newest cycle analyst, and really superb.
Hi, this is Katie with askSlim. A couple weeks ago, we launched a new tool here at askSlim called the Cycle Low Timing Tracker. It's designed to help our members become aware of reversal or continuation opportunities that exist around the ends of current cycles, going into the beginnings of new cycles on both the weekly and daily time frames and the symbols on our focus list. Our focus list does consist of the most widely traded stocks, ETFs, and futures contracts. So let's take a look at a recent opportunity in Walmart, which I have outlined here in blue on the Cycle Low Timing Tracker. So here's a weekly chart of Walmart, and as you can see, Walmart made this intermediate term bottom the week of February 21st and has been moving up nicely ever since. We're currently 5 weeks off that low. Now, we had not released the Cycle Low Timing Tracker yet when Walmart made that low on the weekly chart and started to move up, but this tool is designed to let our members know when exactly this type of activity is happening on both the weekly and daily charts. So for our members who noticed this strong move and wanted to get into Walmart, an opportunity was picked up on the cycle low timing tracker last week. Now, since we use multiple time frame analysis to identify many types of opportunities, let's switch over to a daily chart of Walmart and see what the cycle low timing tracker picked up. First, notice on the daily chart that we have these cycle brackets, which are a drawing tool that helps us to identify money flow patterns. The cycle brackets represent an average cycle length. These blue vertical dashed lines depict a period of time around the end of a cycle when we would expect a cycle low to form. So these particular blue vertical dashed lines that you're seeing on this chart now represent the cycle timing window for the current cycle that we're in. But last week, when we were expecting this cycle to make a bottom, we had a cycle timing window depicted from March 17th to March 25th. So on March 17th, when Walmart entered its cycle low timing window on the daily chart, the timing tracker indicated in the cycle timing category on the daily column that Walmart was in cycle timing on the daily chart. Now, our members can use this as sort of watch list, and they can also subscribe to symbols of interest to them, and they'll get a daily email regarding any cycle bottoming activity in the symbols that they have subscribed to. On March 25th, the cycle low timing tracker put Walmart in the bottom pending category in the daily time frame. This alerted our members to the fact that Walmart was starting to exhibit a certain amount of positive price action to indicate that the cycle bottoming process was underway. Our proprietary indicator, the Slim Ribbon PO on the chart, also gave a buy signal that day. And then on March 29th, the cycle low timing tracker upgraded Walmart to bottom confirmed. And for those of us who had traded the long side off of these signals, you can see how well that worked out. Now, the cycle low timing tracker alerts us not only to this type of opportunity, but it also lets us know when it might not be a good idea to trade the long side, but instead to watch for short side opportunities. If you'd like to learn more about cycle analysis, askSlim, and the cycle low timing tracker, please do visit our website at askSlim.com. Thank you and have a great day.
Thank you for that, Katie. Really, really informative information. This is an important announcement. The askSlim Cycle Analysis Workshop Special. We only do this for about 2 weeks, and we do it every 6-7 months. So if you've been waiting for the special on our cycle analysis workshop, this is the time. This is my method of analysis that you can learn. I developed it over 47 years. This workshop took a couple of years to write and over 6 months to produce. It was a massive undertaking. 21 video modules, plus connected to it are many of our tools for text videos as they apply to each of these modules. You will never look at charts the same as before, just because you will learn a whole new way to project in both price and time and really understand the language of the markets in a whole different way. And on top of that, on May 10th, we're going to have a live event for workshop members. So you'll be able to ask your questions. You'll have plenty of time to review the workshop. There's hours and hours, and many people that have taken this have watched it 3 times through. So you will be quite busy learning from this, and so many things that you will learn that will make so much sense to you. Go to askSlim.com to workshops for info, and also there's a front page link where you can request. You click on that and then let Matt know that you want the special discounted link. And Matt also has a demo reel with a lot of clips from the video, and you can ask him for that also. This is a special $400 discount for 2 weeks only. And if you're a premium member, any level, or you join right now and become a premium level, you'll get an extra $100 off. That's only $797 for this massive informative workshop I'm telling you, you would pay thousands and thousands and thousands of dollars for something similar. Of course, nobody could create anything similar to this because we're the experts here in cycle analysis. For that link, please write to Matt at askSlim.com. He will then give you that information, or go to the top of the front page and click on that link that they put up there, and you'll be able to make that request. Cycle Analysis Workshop Special, only 2 weeks at this amazing price. Please do sign up now. All right, this is our stock market analysis. We do things when we do this analysis for really swing traders or investors, longer term view that we show most of the time, looking at weekly charts. And this is Matt's going to show you our live stream, a stock index report live stream. This is for short term traders, and if you're a day trader or a scalper and you don't have this, you're really missing something. And he's going to explain to you why, this is intraday short-term charts live with no special platform that you can just put up on your screen that has our proprietary information on there. And Matt is going to show that to you right now.
Hello, fellow traders and technical analyst enthusiasts. This is Matt with askSlim. In this brief segment, I'm going to highlight our askSlim SIR Grid Live Daily Chart Stream. This is designed for intraday traders and delivers key insights into primary intraday momentum, key support and resistance areas, and highlights high probability acceleration zones for the S&P 500, NASDAQ 100, and Russell 2000. This proprietary askSlim day trading support service is provided pre-market each market session and is available for our level 2 members and higher. Okay, let's take a quick look at a recent example of the service from this past Wednesday. The purpose of technical analysis and technical tools are to help give you an edge, an indication of a higher probability, not a certainty because there are none, of one outcome happening over another. And that is exactly what the service is designed to do for intraday traders. It's to help bring structure and confidence to your trading each day. So this grid is made up of 2 halves. There's an upside half here, and there's a downside half over here. And this is for the S&P 500, this is for the NASDAQ, and again, the Russell 2000. The upside is focused on identifying the anticipated resistance areas, and those are in light pink and also then in this red color. The downside is focused on identifying the anticipated support areas. That is highlighted in lighter green and then also in darker green. We have also added a custom momentum indicator. We call it our askSlim Reversal Scout, which is used to help identify the likely intraday directional bias, which is the line that shifts from green to purple, and it shifts depending on the intraday momentum condition. Finally, the grid features on both the upside here and on the downside for both of the major indexes. When we have identified such areas, what we call anticipated breakout acceleration zones. These yellow shaded areas are breakout acceleration zones where the analysis suggests that the index will fulfill anywhere from 60% to 100% of the zone once the acceleration line is triggered. Like you can see here, once we violated this 4600 level, the SPX pushed through this acceleration zone very quickly. And then again, right here, the NASDAQ did it here. And then we had the Russell do it twice when this happened on Wednesday. Okay, so when the Reversal Scout is in the direction of the accelerations, the probability of it fulfilling the entire acceleration zone also increases. So what I want to do to finish this off is take a look at key aspects of Wednesday's price action relative to the technical details on the grid. So both the SPX and the NDX opened slightly down, and they tried to rally, and you can see here the lighter pink area is defended really for all 3 of the indexes against that opening rally that came about 45 minutes in. And then the Reversal Scout, you can see, turned over and went negative. And when that happens, that is suggesting that directional bias for that session, when it is negative, is likely going to continue in that direction. So let's see what happened as the day continued. as the SPX and the NDX and the Russell turned over here, they all came into support. And you can see that the support here, which is identified in lighter green, did as it should, where it acted as support as buyers were anticipated to come back in. And there was a minor rally. The rally in the NDX, actually, the decline was a little deeper into that key intraday support zone, where when you get into these darker greens or darker reds, what we anticipate there is that there's going to be a reversal fairly quickly out of there. And we can see that that's what happened in the NDX. And in the SPX, we bounced out of support. However, and this is what's very important when it comes to momentum and directional bias, and this is why this grid is also so helpful, is that the rally occurred. However, the reversal scout, the momentum indicator, which helps us to ascertain directional bias, stayed negative. And when we saw this lower low happen here in the candle, that was a suggestion, as well as if you use other momentum indicators at shorter term time frames, that we were likely to have a reversal back in the dominant direction of the directional bias reversal scout, which was negative at that time. And that's what we saw as we went on to make lower lows for the day, breaking down through, which was initially support through that key support zone into those acceleration zones, and closing then the day in support, and then we had that bounce. So that is typically how the price action works in correlation to the information, the technical details that we provide. Although there are no certainties, our job is to determine the highest probabilities of outcomes, and that's what this grid is designed to do. Okay, that's all I have for today. Remember to go to askSlim.com for more information regarding our premium memberships. This is available for level 2 members and higher, or you can write to me at matt@askSlim.com for special trial offers. We wish all of you great trading.
Thanks for that, Matt. That was just so informative. And if you're a short-term trader, please do write to Matt and ask any questions that you have, or become a level 2, 3, or 4 member, and you will be able to have that live on your screen. This is the stock market analysis. We're going to give you a 1 to 3 month view. We're going to look at the SPX, NASDAQ, RUT, and the VIX for correlation purposes. I'm going to first go to the VIX to do this analysis, because I think it's going to be really important to kind of zoning in on the time frames that we're looking at. And this chart I'm going to show you starting out is kind of a messy chart. And let me just switch over. I have a high yield chart, and if you didn't see this analysis in the beginning of the show, please do go back and you'll see why I am going to be pointing to a low coming in July or August for the stock market. But I'm not going to review this again now. Go back and watch the beginning of the show if you didn't do that. But now we're going to switch over from HYG to VIX. And this is the weekly chart in VIX. Yes, this is a very busy chart, and does it ever have important information on there for you to see? Let me just zoom in a little bit more. These are harmonic families. Now, if you're brand new to our analysis, on the bottom are cycle brackets. If you're an old pro at our analysis, then you're using the cycle brackets right on your charts, or you're getting it on our charts that we supply to level 4 members live for Thinkorswim platform. So each of these harmonic families is broken up into minor halves and minor quarters. All cycles don't break up into halves and quarters. They might break up into thirds, and they might have cycles that are out of phase, not perfect like you see in here. As you could see, this big dominant cycle right there, it translated into this big upside move and then came down right in here. The green areas are areas where the stock market moves into higher risk periods. That's after the minor fourth quarter right there, and after the minor fourth quarter right over here, and after the minor fourth quarter right over here. Implied volatilities then begin to move up, and can move up sharply, as you see right in here. So where are we right now as far as the harmonics on the VIX? Well, you can see in there the note that we have in there. The next major VIX low, the timing range for that, is mid-May to early June. These blue vertical lines you see right over there are the three of them, meaning that all three of these cycles are coming down at the same point. When that happened right over here, you see implied volatilities were falling and the stock market was firm. Right over here, we're getting to where we're getting a rebound, but the fourth minor quarter cycle tends to not have higher implied volatilities that can last. That means the stock market is likely to stay in its rebound all the way into this timing zone right here. That's the timing zone for the implied volatilities, the VIX, to make their lows. They got down over here to about 18.5. We could see them down under 18 right over here in this period between middle of May and early June. If that happened, then you know that the stock market still would be in decent shape in this rebound. And this is really the time frame. Then when you get past this timing zone, that's when the stock market high risk begins again. And if you caught us in the beginning of the show, we talked about the May-June time frame. April, May potentially is a stronger market. We said 4 to 8 weeks from now, likely we're going to see a peak in the market. That's the peak in the stock market at these low implied volatilities. And then the stock market risk begins again. That's why we keep saying this is the time to be a seller in the stock market over these next couple of months as the stock market begins to move up. So let's take a look at SPX, which now we have a reason to be pointing to that the high date somewhere up in that May-June period. And you can see in our projection right up over here that we are looking for this May-June period for the time that begins to roll over. Now, it rejected getting up near the 78.6. I said also in the beginning of the show that it's very often that when bear markets form, and if you look at the JN at the HYG, it didn't rebound hardly at all, and that indicates trouble for corporations. Add that to the fact that this is a lower low right over here than this, and it suggests that a big failure is coming in this area. Now I'm going to show you three charts following this. This is two charts following this, the NASDAQ and the Russell. I want you to see that the rally got up close to the 78.6. As bear markets form, sometimes one of the major indexes gets up over the 78.6 and even tests the all-time high, with other indexes not confirming. So there is room in here on the upside still, and the stock market is pulling back in what we believe is a short-term low that's going to form and then try to get up here again. So we're looking for this decline to end, it try to rally again, but really struggling up here with the potential for 46.65, maybe up into the 4700s, for the S&P 500 before it then begins to top. The nested bottom right over here is the September to November period, and I'm looking a long way out, kind of big picture, but that's really where there's a potential for a lot of declines. And I showed you July, August on the high yield bonds, that they're pointing down sharply into that area. So late summer into the fall could be a lot of risk for the stock market out there. In the meantime, it's in this sharp rising phase, almost got up to the 78.6, and likely to try to get higher again before this is over with. You can see in here our analysis is made up of three major components: cycle analysis, momentum analysis, and on the weekly chart we're using our reversal scout, and also what we call swing high, swing low analysis, where we do the fib projections and support and resistances. So in this case, momentum turned up right over here, and of course it's moving up, so it gives us a sign that it's fairly likely there is upward inertia that's going to keep the market moving higher for the near term. If the market were to get much weaker and this turned down again, that would be a bad sign. You can see what happened when it started to falter here and then turn down. It set up a decline through this entire cycle to this nested area, as we call it right there. So that explains the S&P 500 again getting up near the 78.6%. Now, Apple had an absolutely monstrous move as it rallied from 150 up to about 175. And then has pulled back. But while the S&P 500 threatened the 78.6, The NASDAQ, which also has now established positive momentum, has rejected near the 61.8. So you see the NASDAQ is actually weaker, even with Apple moving up so strongly. That simply tells you that Apple has been leading this way up, but the rest of the NASDAQ actually is lagging the S&P 500. So that gives you some sense that the rallies are likely not to be able to hold up that well. When you look here at this note that we have here, again, the major nested bottom out there in all indexes sinks out to a major decline into September through November. So again, the NASDAQ gets up to the 61.8%. When I look at the small cap zombie stocks in the Russell, you can see in here much weaker, and it gets up into that resistance sell zones right over here and begins to struggle. Now this right over here is the intermediate 50%. Remember, the NASDAQ made it up close to the 61.8 right here. The S&P 500 made it close to the 78.6. These small cap really stocks that don't have much in the way of earnings, well, they really get hammered by higher interest rates, and higher interest rates are coming. And this calls for this cycle, different than the rest of the market, a decline actually that could come out into June period right over here. And then ultimately this big cycle right here pointing to a serious decline in the market out into October. So that's that same period, September to November, where there's a lot of risk in the markets. The sum of the evidence as I look at this is that, we're in a rebounding period, but everything that is rebounding is mostly lagging. The S&P 500 doing much better than the other indexes, and the VIX pointing to this rebound that we have in the market bottoming sometime in the late May period. And then entering into a period of higher implied volatilities, which means likely higher volatility in stocks or lower prices, with the NASDAQ and the Russell lagging, and the Russell lagging a lot. There is a correlation between the Russell and HYG, high yields, of course, because higher interest rates just simply sabotage the earnings of companies that borrow a lot of money. And that would be a lot of stocks in the Russell category. So that's kind of the 1 to 3 month plus view for the stock market, with really extensive look and I think proofing, and in this case not proof of life but proof of death for the stock market bull market, even though it has probably 4 to 8 weeks to go in the rally that you see right now. That's it, our stock market review. I want to remind you, learn about our cycle analysis. We have a workshop right now, and you could save $400 or $500 off of it just by writing to Matt at askSlim.com, and he'll give you all of the information you need about that. Please do go to askSlim.com. Check out our website if you haven't been there before. Sign up, be a free member. On YouTube, subscribe to the channel, click the notification bell, and give us a thumbs up, like the video, and do watch some of the member videos that are on the playlists in there. On Twitter, follow us at askSlim. And for all of the information that I have told you that is available to you, for information on all of our memberships, everything on our huge offerings of education and analysis, how about 600 plus videos to teach you stuff, write Matt at askSlim.com. I want you to be so unbelievably careful. It is so crazy out there. And I'm always wishing you great trading.
Well, I'm going to the city and I'm gonna do a city show. And I know all my fans wanna learn how to make some dough. I've been cruising